Hi, everybody. This is Ellman, the Blue Collar Investor, and welcome to this BCI podcast number 6, titled Trade Management, a real-life example with Brooks Automation, Inc., that trades on the NASDAQ exchange under the ticker BRKS. Now, the trade or series of trades that I'm about to discuss with you was actually executed by one of our members. We're going to go through each step of these series of trades and comment on whether or not the trade could have been executed better or actually was the perfect trade to execute at that point in time. For those of you listening but not watching the actual screenshots of this podcast, I'll do my very best to be as descriptive as possible. Now, the chart on the screenshot shows the series of trades running from 1 through 6. Let's go through those steps now, and then we'll move on to commenting on each trade. So on June 18th, 2018, the stock was purchased at $36.13. At that same time, the option was sold. The 35 call option, 1 month out, was sold for $2.15. So the in-the-money 35 strike was actually executed $1.13 less than current market value. Now, 1 week later, the chart shows that the price of the stock declined. So we closed that 35 strike short call, buy to close, for 50 cents, approximating our 20% guideline. Now, on July 11th, which corresponds to number 3 on the chart, the option was sold, the 35 option was sold at $1.40, rolling out from the current contract. So the buy to close cost was $50, and the sell to open the next contract month was $1.40, netting a credit of 90 cents per share. Now, on July 27th, during that August contract, this member closed the August 35 call for 35 cents, and on the very same day sold that same call for 30 cents. And this resulted in a debit of 5 cents per share. And then finally, the option was closed on August 17th at 5 cents, while the strike was out of the money. Okay, so that said, let's first have a look at the initial returns for the initial trade. If you recall, the stock was purchased at $36.13, and the July 20th expiration 35 in the money strike was sold at $2.15. Now, we can't count that entire $2.15 as profit because we're going to lose $1.13 on the sale of the stock. So we have to deduct that intrinsic value of $1.13 from the $2.15, and that results in a ROE, or return on our option, of 2.9% for the 1 month. So that's pretty good. Now, there is no upside potential because if the share appreciates, we are still obligated to sell at 35. So we're getting no benefit of share appreciation whenever we sell an in-the-money strike. However, because we sold an in-the-money strike with intrinsic value, the downside protection, as the calculator shows, is 3.1%. This means we are guaranteed a 2.9% 1 month return as long as share value does not decline by more than 3.1%. Or stated differently, as long as share value does not decline from $36.13 to below the 35 strike. All right, let's go through all the steps now, and I'll kind of comment as we go along. On 6/18, BRKS was purchased at $36.13, and the in-the-money 35 call was sold at $2.15. Well, this is an excellent defensive trade because you get a time value return of 2.9%. Remember, this is just 1 month, with protection of that time value profit of 3.1%. It's almost like we have an insurance policy on the time value profit. Now next, the option was closed, the short call was closed for 50 cents. Well, this kind of approximated the 20% guideline, and I would say to that, well done. Now, on July 11th, the option was sold at $1.40 rolling out. So the contract ended and the next contract was beginning. So there was a rolling out and we generated $1.40 on the August 35 call with a net credit of 90 cents per share. 140 minus the 50 cents cost to close. Okay, so that rolling out actually netted a credit of 2.8%. Now, the actual rolling out took place several days prior to contract expiration. I normally like to wait as close as possible to 4 p.m. Eastern Time on the third Friday of the month for the monthly contracts to roll. But okay, the credit was fine, 2.8% was fine. Now, here's where I believe an error was made, and that's on July 27th, when the August 35 call was closed at 35 cents and then reopened on the same day at 30 cents. So we ended up in the same spot, but with a net debit of $5 a contract. So that step was not necessary. Now, finally, on August 17th, the 35 call was closed at 5 cents, but the strike was well out of the money. So there was really no need to buy back that option. The option would have expired worthless the following day, that Saturday after expiration Friday. So some of the moves here were outstanding and some of them were really unnecessary. Now the question is, should we have rolled into the August contracts? Now I'm currently showing a screenshot of what BRKS looked like at the time that the option was rolled to the next contract month. And you can see on the screenshot here that there was a bearish trend. The 20-day exponential moving average was trending down and actually dropped below the longer-term 100-day exponential moving average. That, ladies and gentlemen, is a bearish signal. However, the momentum indicators were actually bullish. The MACD histogram had just moved above the zero line, a bullish signal, and the stochastic oscillator had recently moved above the 20th percentile and was trending up. Now the volume during these signals was a bit on the low side. All in all, I would call this a mixed picture. So if we have a mixed technical picture, it's possible that we may have had better stocks to select. However, it would not be an egregious decision to continue. Now, there was actually a surprise ending to this trade because shortly after the option was rolled out into the August contracts, Brooks announced a sale of its semiconductor cryogenics business to Atlas, and that caused a huge spike in share price. So for our member who went into this trade, the story did have a happy ending. But it's important to understand, first of all, it's critical to execute exit strategies when those opportunities arise. In this case, there were several that did arise, but a few that were created that weren't actually necessary. So as we hone our position management skill, we're going to get better and better at this and execute only the ones that will benefit us in the long run. So just to review some of the management factors that are used and were used in these trades, the 20%, 10% guidelines as to when to buy back the short call, looking at price charts, technical analysis, will give us a good feel for whether or not we want to stay with this stock, whether or not we're bullish or bearish as to how we manage our exit strategies. We also must factor in time to expiration. You know, rolling an option too early is not something that generally will benefit us. We want to avoid earnings reports, and this was not an issue in this case. And finally, setting up calculation return goals. Now, for me, it's 2 to 4% in normal market conditions. I'll go as high as 6% in bull markets. And the initial return here was 2.8%. And when the trade was rolled, it was 2.8%. So 2.9 and 2.8. Pretty good if your goal is 2 to 4%. So that's it for BCI podcast number 6. I want to thank everybody out there for taking the time to watch this video. I hope you enjoyed it. And most importantly, I hope you benefit from it financially. As always, this is Ellman, the Blue Collar Investor. Take care, everybody.